The allure of high-growth sectors like artificial intelligence, well, it's undeniable right now. It's buzzing, it's exciting, and everyone wants a piece of it.
Yeah, they really do.
But you know what we do here on the deep dive? We don't just ride the hype wave, we lift up the hood. We look under the hood at what's actually powering the companies in these hot sectors.
And sometimes, when you look under that hood, you find the engine is sputtering or maybe not even running at all.
Mm.
We're diving into a situation today where a company operating squarely in the middle of that high-growth AI world appears to be facing some pretty significant, maybe even existential challenges.
Okay, let's unpack this. Our mission today is a deep dive into Remark Holdings, Inc., ticker MRK. This isn't just a general overview. It's based entirely on a detailed value investment analysis provided by one of you, our listeners.
That's right.
We're going to work through this analysis, examining the company's profile, financials, management risks, and market standing, looking at it through a lens similar to the principles Warren Buffett uses specifically based on the information available as of May 23, 2025.
Right, using that framework.
Our job is to extract the most important nuggets of knowledge and insight from this detailed source material for you.
And as we reach the conclusion of this deep dive, we'll reveal something significant about Remark Holdings' situation based on this analysis, and actually show you exactly how you can get this kind of tailored, in-depth look at the companies you're interested in.
All right, the source material is this in-depth analysis provided to us. That's our guide. Let's jump in. So, kicking off the first half of this deep dive, let's start by simply understanding what Remark Holdings is. What does the analysis tell us about the business?
Right, Remark Holdings, ticker MRRK. It's a technology company primarily focused on AI-powered solutions, with a specialization in computer vision analytics. The very first thing this analysis highlights, and it's a critical point, is their current status as of May 2025. They're trading on the OTC markets, specifically OTC Pink, or Remark.
OTC Pink, so not NASDAQ.
No, they were delisted from the NASDAQ back in February 2024 because they failed to meet NASDAQ listing standards, including the minimum net income requirement. That's a big deal right off the bat.
Okay, so they're not even on a major exchange anymore. What about the core business? What does their technology actually do?
Well, the sources describe key platforms. There's the Smart Safety Platform, or SSP, which uses AI computer vision to analyze video feeds, things like detecting objects, people, or specific behaviors for public safety or retail environments. They have an Aviation Safety Platform, ASP, using AI for things like speeding up aircraft inspection times or enhancing safety protocols.
Okay.
And Drone Video Analytics, DVA, which analyzes real-time video streams from drones, useful for applications like law enforcement or security.
I saw mention of a historical platform called CanCan AI, which was largely focused on China. Has that changed?
Yes, and it's a significant strategic shift the analysis points to, due to the economic slowdown in China post-COVID and rising political tensions between the U.S. and China.
Right.
Remark has been actively pivoting away from that market, downsizing operations there, and trying to refocus on regions like the U.S., U.K., parts of Central and South America, and Asia-Pacific, excluding China.
Has that pivot changed where the revenue comes from then?
Absolutely. According to the Q3 2024 filing referenced, a staggering 98% of their revenue for the 9 months ended September 30, 2024, coming from the U.S. and U.K., was AI-based.
Wow. Okay.
So while they used to have digital media assets, the analysis makes it clear revenue is pretty much almost entirely AI now.
What about partnerships? I think for a smaller tech company, partnering with giants would be key.
You're right, and the analysis highlights partnerships. They work with Microsoft, leveraging Azure and GPU services, and Remark itself projected this could lead to a potential $240 million by 2029.
Yeah.
That's ambitious given current numbers.
Yeah, $240 million seems very optimistic.
It does. There's also a very recent collaboration announced in May 2025 with Google Public Sector for some New York State projects, a 2-year agreement that could offer some external validation. However,
There's always a however.
there usually is. The analysis strongly emphasizes that despite these partnerships, they simply haven't translated into sustainable revenue or profitability yet. That's a critical gap.
Okay. How do they pitch themselves? What's their stated value proposition to customers?
They claim to simplify AI, taking complex data and turning it into actionable insights, emphasizing ease of installation and integration to their platforms, making AI accessible.
And who are they trying to sell this to? The list of target markets in the analysis seemed incredibly broad.
Extremely broad. Public safety, retail, construction, aviation, transportation, energy, even financial services historically. The analysis raises a key question for you to consider. For a relatively small company with limited resources like Remark, does trying to serve such a wide range of markets help them by offering versatility, or does it actually hurt by spreading their limited resources too thin, preventing them from truly dominating or specializing in any single area?
That's a great question. It feels like focus would be critical there. So, looking at this through a value investing lens, how does the business itself stack up?
Well, understanding the business means looking at its long-term potential. The market they're in, AI computer vision, definitely has tailwinds. Projections show strong growth.
Yeah, the market's hot.
It is. One source puts it from roughly $23 billion in 2025 to over $63 billion by 2030 at a 22% annual growth rate. Another sees growth from $56 billion to $117 billion at a nearly 16% CAGR. The industry itself is growing fast.
But, and this is the key part I remember, the analysis immediately contrasts those favorable industry tailwinds with Remark's significant internal headwinds.
Exactly. That's the core conflict here. The analysis then digs into the economic moat, the company's sustainable competitive advantage, something crucial for a value investor.
Right, the moat.
On proprietary tech and IP, Remark claims patents, but the analysis flags ambiguity and concern. One source noted no new patents, and a search found old, unrelated patents, raising a big question mark over whether they have robust, current IP truly protecting their AI. If their core technology isn't well protected, it can be easily replicated, which is a huge risk in a fast-moving field like AI.
Yeah, definitely. What about brand recognition or market position?
Minimal to negligible. The analysis points to microcap status, the delisting, and lack of brand recognition as clear signs they are a fringe player. An old 2019 ranking was mentioned, but that's ancient history in AI terms.
Okay. Network effects. Probably not much there.
Not significant at their current small scale.
Yeah.
Nope. Switching costs are highlighted as a potential advantage, but with a big caveat. If their solutions were deeply integrated into a client's operations, replacing them could cost 20–40% of the system cost. But the analysis calls this a theoretical advantage because they haven't actually achieved widespread, deeply integrated customer bases. It's potential, not proven.
Got it. So a pretty weak moat overall based on this analysis, and the competition, the sources really emphasize how brutal the AI computer vision market is.
It's incredibly intense. You've got giants like NVIDIA, Microsoft, Google, Amazon, who are spending billions on R&D. Billions.
Right.
Remark's R&D spend in FY 2023 was just $1.89 million.
Million. With an M.
Million with an M. That's not a typo, $1.89 million.
Right.
Trying to compete head-to-head on innovation with companies spending thousands of times more is, well, incredibly difficult.
Yeah, almost impossible.
Partnerships are pragmatic, as we noted, but they also highlight Remark's dependence on those larger entities. They're swimming with giants, and they're tiny.
Okay, that gives us a picture of the business and its place in the market. Next, let's look at Chapter 2, Management. Who is steering this ship?
The CEO is Kai-Shing Kao. He's been at the helm for a long time, over 12 years, since late 2012.
12 years is a long time.
It is. And the analysis is blunt here. His tenure has coincided with significant, sustained destruction of shareholder value. The stock price is down 99% over the last 5 years.
99%, wow.
They've had persistent, heavy losses, and it all culminated in that NASDAQ delisting. That's a tough track record, to say the least.
Given that performance, what does the analysis say about his compensation? Seems like it should be minimal.
Well, for FY 2023, his salary was $350,000, with $150,000 at a deferred.
$350,000
Yeah.
for a company this size and performance.
Exactly. The analysis highlights this as a substantial figure for a company with a $3–4 million market capitalization, persistent losses, and negative shareholder equity. While some data providers might label it consistent with company performance, the analysis finds it hard to reconcile that with the actual performance outcome, significant value destruction.
Yeah, that doesn't seem aligned at all. What about his ownership stake? Does he own a lot of shares, aligning his interest with shareholders?
His direct ownership percentage is relatively small for his long tenure in a microcap company. The sources show percentages around 0.89% or maybe 0.4%.
Less than 1%.
Yeah. The analysis questions the degree of financial alignment with common shareholders, given his long time in the role and that smaller stake.
And the board of directors, are they providing effective oversight?
It's a 5-member board. Non-employee directors are formally independent, and they have the standard committees: audit, comp, nom/gov. But the average board tenure is quite long at 8.2 years. The analysis asks whether this long tenure, in the context of the company's poor performance, signals valuable experience or potentially suggests entrenchment and a lack of fresh perspectives needed to address deep-seated issues. The effectiveness of oversight appears questionable.
Right, experience is good, but maybe not if the results aren't there. This brings us to executive compensation structure. Was the CEO's pay linked to financial performance? Please tell me it was.
Actually, no. This is a really critical point the analysis pulls out. It explicitly states that for 2023, no financial performance measures were used to link the CEO's compensation to the company's financial results.
You're kidding, for a company in this kind of trouble.
Not kidding. The analysis highlights this as a significant governance flaw, particularly for a company in distress. Existing stock options granted years ago are deeply out of the money, essentially worthless, reflecting past failures rather than providing current performance incentives.
So the compensation wasn't structured to incentivize a financial turnaround. Okay, how about capital allocation? How has the company been spending or raising money? Have those decisions been better?
Well, the analysis is critical of historical decisions there, too. R&D spending has been declining sharply from $4.69 million in FY21 down to just $1.89 million in FY23.
That tiny R&D number again?
Exactly. For an AI company, the analysis calls this alarmingly low and plainly insufficient to keep pace with rivals or maintain a competitive edge. Past acquisitions, particularly in digital media, haven't built a profitable core business. They've kind of pivoted away from those. The financing history is where the picture gets really grim. There's a pattern of significant shareholder dilution.
We'll come back to dilution, I'm sure.
Oh, yeah. The company has relied on costly, complex, and sometimes distressed financing methods. They even defaulted on an equity line of credit previously. More recently, they announced a plan for a $75 million preferred stock offering with a punishing 15% annual dividend.
15%, that's incredibly high.
That's loan shark territory almost. These are hallmarks of desperate measures taken by struggling companies and impose very high costs or future dilution. Their obligations to issue common stock related to financing arrangements also ballooned significantly, from like $1.09 to $10 in a year.
So the capital allocation seems driven more by needing cash now for survival than by a clear strategy for long-term growth.
Precisely. The proceeds from that incredibly expensive preferred stock are intended for growth and conversions. But the analysis points out that the company's ability to actually execute on any growth strategy is severely constrained by its weak financials and the high cost of that capital itself.
When we connect this back to value investing principles, how does the management team look based on this analysis?
Well, the analysis concludes that based on assessing management's capability, their history, and their alignment, or maybe lack thereof, with shareholder interests, the picture raises serious concerns. It does not align with what value investors typically look for in terms of competent, shareholder-focused leadership.
Okay. All right, let's move to Chapter 3, the financial health of Remark Holdings. This is likely where those significant internal headwinds we mentioned really become starkly visible.
They absolutely do. The analysis characterizes the historical financial performance with extreme volatility, but consistently marked by declining revenues and persistent, heavy unprofitability.
How bad are the revenue trends? You mentioned the pivot away from China.
Quite dramatic. FY 2023 revenue plummeted 62% to just $4.4 million, down from $11.7 million in FY 22, largely attributed to that China slowdown and strategic pivot.
Wow, that's a huge drop.
And the revenues can be incredibly erratic.
Yeah.
The analysis points to Q3 2024 revenue being a mere $0.32 million as an example, like almost nothing for a quarter. Profitability, there isn't any, just consistent, substantial net losses year after year.
Okay, give us the numbers.
$29.1 million in FY23, next at $55.5 million in FY22. A gain in FY21 was a one-time event, not from core business profitability. Q3 2024 was another significant net loss of $28.7 million, including a large $6.5 million impairment charge related to China.
So the losses are huge, often bigger than the revenue itself.
Way bigger. The analysis noted earnings have actually declined by about 19.4% per year over the last 5 years. This company is just bleeding money.
Losing money isn't good, obviously, but how dire is their current financial health? Like cash on hand, ability to pay bills?
The analysis describes it as exceptionally poor. Liquidity is minimal. They had only $143,000 in cash as of September 30, 2024.
$143,000, that's nothing for a company.
Basically pocket change. Think about that. Pennies in the bank. Their current ratio is disastrously low, somewhere between 0.03 and 0.18, meaning they have just a few cents in current assets for every dollar of short-term debt. They simply cannot meet their immediate obligations.
Okay, so they can't pay their bills. Solvency, are they technically still solvent?
No. Technically insolvent. They have negative shareholder equity, a deficit of $55.6 million as of September 2024. Their debts simply outweigh their assets. The company is underwater.
Wow. Insolvent. And what's the debt situation like specifically?
It's high and distressed. Total debt over $24 million in September 2024. And crucially, $16.3 million in notes payable were past due as of June 2024.
Past due. So they're defaulting.
It certainly looks like they weren't paying their lenders on time. That's a huge blinking red light. The analysis also notes significant obligations to issue common stock related to financing, reaching $13 million by June 2024, and advances from related parties, which often means insiders are propping it up.
Yeah.
The debt-to-equity ratio is negative because, well, equity is negative. This is the kind of debt profile you see in companies on the brink.
Even if they had positive gross margins, it sounds like operating and net margins must be terrible.
They are. Gross margin was positive but low, around 24.5% in FY23. That means revenue is just a little more than the direct cost of their product or service, but after all, operating expenses.
Yeah.
The analysis highlights deeply negative operating and net margins. Operating margin was negative 389.8% in FY23 and TTM over net 1100%. Net margin was negative 662.1% in FY23, TTM nearly negative 800%.
Wait, negative 1,100% operating margin. How is that even possible?
It means their operating expenses absolutely dwarf their gross profit. The analysis stresses this reveals a fundamental flaw in the business model as currently operating a bench. They're losing multiple dollars for every single dollar of revenue they bring in after all expenses are accounted for.
Okay. And is this company generating cash or burning it? Seems like an obvious answer.
Definitely burning it rapidly. They have persistent negative operating cash flow. They used $10.5 million in cash from operations in FY23, and the TTM figure is around negative $8.41 million. This constant cash burn forces them into that cycle of needing external financing, often on terrible terms, just to keep the lights on.
Right, like that 15% preferred stock.
Exactly. The analysis notes an anomaly in one source's free cash flow figure, but emphasizes the reality is deep negative cash flow.
So, summing up the financial picture, it sounds like financial viability and going concern risk are not just issues, but the issue.
Absolutely. The analysis concludes there is substantial and immediate going concern risk. Their survival is entirely dependent on being able to raise more capital, which, as we've seen with that expensive 15% preferred dividend plan, is incredibly difficult and costly for them. The risk of bankruptcy or permanent total loss of capital for shareholders is very high.
The analysis includes a table of key financial metrics: revenue, losses, debt, cash, solvency, and frankly, just looking at the numbers laid out side by side reinforces this dire picture. It's pretty shocking.
It is. For a value investor, this section is screaming red flags. It shows a company in acute financial distress, and that the stock price, no matter how low it might seem, is not sensible relative to the fact that there's negative equity and the company is actively bleeding cash just to survive.
That covers the first half of our deep dive into Remark Holdings. We've lifted the hood on the business itself, assessed the management team's track record and incentives, and laid bare the company's severe financial health based on the analysis.
The story emerging here is one of a company struggling mightily against profound internal challenges, despite operating in an otherwise exciting sector. It's quite the contrast.
Let's take a breath, and then we'll jump into the second half to look at how the market is reacting, who actually owns the stock, and a comprehensive look at the myriad risks facing Remark Holdings. Welcome back to the deep dive. We spent the first half looking under the hood at Remark Holdings' business model, management, and frankly, disastrous financial situation based on this in-depth analysis. Let's move into the second half, starting with Chapter 4, how the market perceives this company.
Right, market sentiment. It's interesting here because it reflects how the broader investment community is reacting to the pretty grim picture we just painted. So how much analyst coverage is there?
Very sparse, which isn't surprising for a distressed microcap trading on the OTC pink seats. The analysis mentions Maxim and Roth historically, but without recent estimates. Fox Business showed a single analyst rating and was a clear sell.
Just one sell.
Yeah. This lack of coverage signals that most mainstream analysts and investment firms aren't paying attention to this company. Or if they are, they don't like what they see.
What's particularly noteworthy, and something we need to highlight for you listening, is the mention of potentially confusing short-term technical signals from some sources. Places like TradingView, StockInvest.us, or Zacks might show short-term technical buy signals or favorable technical scores.
Okay, that sounds completely contradictory to everything we just discussed about their fundamentals. Why is that, and why should we be cautious?
Yeah, it's a trap you can fall into. Technical indicators focus purely on price and volume movements, often over very short time frames. For a company that is fundamentally insolvent, desperately illiquid, burning cash like crazy, has past due debt, and has been delisted from a major exchange,
Right.
any technical buy signal is likely just noise, maybe some speculative trading or a quirk of the algorithm. It should be viewed with extreme skepticism. It does not reflect underlying value or a fundamental turnaround.
So ignore the technicals here.
Pretty much. The overwhelmingly negative fundamental picture we just covered completely outweighs any short-term technical blips. Don't get distracted by them. Focus on the business reality.
Got it. So the overall market perception, despite any technical noise, is pretty negative then.
It's clear. The delisting from NASDAQ, the stock price trading for pennies, the financial distress, these are the market's reflection of deep skepticism about the company's future viability. The market isn't blind to these issues.
Moving to Chapter 5, ownership structure. Who are the shareholders holding the bag, so to speak? Any big institutions involved?
Almost none. Institutional ownership is negligible, consistently reported at less than 0.25% as of May 2025.
Less than 1/4%.
Yeah, this is a major indicator. Professional money managers and large funds are simply avoiding the stock. The analysis mentions Mudrick Capital had a 9.99% stake back in August 2024.
Okay, that's one name.
But Mudrick specializes in distressed investments. Their focus is likely on potential restructuring events, maybe paying the debt, not necessarily a belief in the operational turnaround of the core business. It's a different kind of investing. Insider holdings show some variation depending on the source, but the analysis highlights that while CEO Tao's direct stake is relatively small, as we discussed,
Right. Under 1%.
a director and 10% owner named Wai Zhu potentially has a more significant stake, around 14.4% according to one source, Fintel. The implications depend on their intentions and active involvement, but it points to some concentration of ownership outside the CEO.
You mentioned dilution earlier as a method of financing. Is that still a major concern looking at the ownership structure?
Absolutely. It's a critical concern highlighted repeatedly by the analysis. There has been severe ongoing shareholder dilution. Shares outstanding increased by nearly 40%, 39.7% to be exact, in the past year alone.
40% increase in shares in 1 year.
Yes. This is a direct consequence of the company desperately issuing new equity, likely at very low prices, to raise cash just to survive. For existing shareholders, this directly erodes the value of their per-share ownership. It's a nightmare for anyone trying to hold on for the long term.
Yeah, that makes any potential upside per share much harder to achieve. The analysis includes a table summarizing these holder categories, showing how little institutional money is involved and how the ongoing dilution impacts the overall structure.
It paints a clear picture. The stock is largely abandoned by mainstream investors, and survival maneuvers are constantly diluting the value for those still holding shares, who are likely mostly retail speculators at this point.
Okay, Chapter 6, Risk Assessment. The analysis lays out the major risks facing Remark Holdings, and it sounds like there are quite a few.
Right. The analysis provides a systematic look at the significant threats, even if not labeled strictly as SWOT. First and foremost are the financial risks, which we've already discussed but are worth reiterating because they are so severe.
Yeah, let's recap those quickly.
Insolvency, they owe more than they own. Illiquidity, they have almost no cash and can't pay bills. Massive cash burn. They're losing money constantly. The crushing debt burden, including those past due obligations. Ongoing dilution, vaporizing shareholder value. And the very high going concern risk.
Meaning they might not survive.
Exactly. The analysis emphasizes their existence literally hangs on its ability to somehow raise more cash, likely at ruinous terms like that 15% preferred stock. The risk of bankruptcy is extremely high. Operational risks are substantial too. Executing that strategic pivot away from China, trying to build market share in new regions with minimal resources, is incredibly difficult and high risk.
Right.
Intense competition remains relentless. Trying to innovate and sell against giants spending billions is a constant uphill battle. And that insufficient R&D spending we keep mentioning means they're at high risk of their technology becoming obsolete in a rapidly advancing AI field.
What about market risks, just general market stuff?
Well, there's the volatility inherent in the tech sector, sensitivity to broader economic downturns, And the stock itself has a high beta, around 2.97.
Beta of almost 3.
Yeah, meaning its price swings are typically 3 times more extreme than the overall market. So it's a wild ride even without the company's internal problems. The analysis also specifically considered the potential impact of the 2025 U.S. tariffs on Chinese technology.
How could tariffs on Chinese tech, even with their pivot away from China, affect Remark? That seems counterintuitive.
Well, while their direct China revenue exposure is reduced, tariffs on things like semiconductors, AI hardware components, or potentially even cloud services could still impact them indirectly.
Through their supply chain.
Exactly. If their suppliers face tariffs, those costs could get passed on to Remark, increasing their cost of goods sold or operating expenses. This would put even more pressure on their already deeply negative margins. It could also disrupt supply chains for any hardware components their AI solutions might rely on, and potentially put them at a cost disadvantage compared to competitors with less exposed supply chains.
Okay, that makes sense. What else?
Other risks include regulatory, legal, and geopolitical. The complex and ever-changing global regulations around AI and data privacy are costly and challenging for a small company to navigate. And broader U.S.-China tensions, which already forced their pivot, could create further unpredictable disruptions. Finally, IP and supply chain vulnerabilities. We touched on the weak or ambiguous patent protection, leaving them vulnerable to others potentially copying their tech. And as noted in their own filings, reliance on specialized supply chains for high-tech components needed for their AI development poses a risk of disruption.
So the analysis paints a picture of a company facing an absolute mountain of risks across every domain: financial, operational, market, geopolitical, technical.
It does. The risk factor summary table in the source, just listing them out, is sobering. It reinforces the multifaceted and high-impact nature of the challenges they face. It's not just one thing going wrong, it's many things.
All right, that brings us to Chapter 7, the conclusion and the reveal of our end hook. Based on this comprehensive analysis we've worked through, let's synthesize the findings. What's the bottom line here?
Okay, pulling everything together. Remark Holdings is indeed in a promising AI sector, computer vision, which has strong growth tailwinds. That part is true. However, this analysis makes it abundantly clear that the company itself is fundamentally crippled by severe self-inflicted and external issues.
Right.
The key takeaways are profound financial distress, persistent, heavy losses, negative shareholder equity, meaning they're technically underwater, significant and ongoing cash burn, a crushing debt burden, including past due obligations, severe constant shareholder dilution, and a very high immediate going concern risk. They've simply not demonstrated a sustainable, profitable business model. Management's long track record coincides with value destruction and raises serious concerns about capability and alignment. And they face intense competition with insufficient resources to truly compete on innovation or scale.
How does this stack up against core value investing principles like those espoused by Warren Buffett? Does it meet any of them?
Well, the analysis concludes unequivocally that based on this deep dive, Remark Holdings fails nearly all of Buffett's core criteria. Is the business easily understandable or defensible? Not really, given the broad focus and questionable IP.
No moat.
Is there a discernible economic moat? Clearly not. Competition is fierce, resources are minimal, and advantages are theoretical at best. Is management capable, honest, and aligned? The track record of value destruction, questionable compensation practices, and capital allocation decisions raise serious concerns here.
Okay.
And is the price sensible relative to the value? With negative equity, massive cash burn, and a very high risk of bankruptcy or further ruinous dilution, the analysis argues the price, no matter how low, is not sensible. The extremely low stock price reflects the market's accurate assessment of its dire situation, not undervaluation of a sound business.
So the final assessment from this analysis, what kind of investment, if any, is this?
Remark Holdings, based on this deep dive, is characterized as a highly speculative situation. The analysis points to a very significant risk of permanent capital loss. It is deemed entirely unsuitable for a prudent value investor. This is a company fighting desperately for survival, not one focused on creating long-term value for shareholders.
That's a stark but clear conclusion based on the financial and operational realities presented in the sources. It really shows you need to look beyond the exciting industry label and focus on the company's actual foundation.
It does. The AI buzz is real, but the company's health is what truly matters for an investment.
Now, to connect this all back to our hook, this in-depth, customized analysis, pulling out the critical details and synthesizing them into a clear picture like this deep dive, is exactly what we provide. This specific deep dive into MR was generated from a detailed analysis requested by one of you, our listeners.
And you can get similar deep dives yourself. Stock Analytics AI offers a subscription. For members at the Euro 4.99 per month tier, you can give us a ticker that you're interested in, and we prioritize a detailed deep dive analysis and earnings summary like this for you.
It's about getting that comprehensive, tailored look at the companies you care about, cutting through the noise and getting those critical nuggets of knowledge and insight directly from the analysis, delivered in this deep dive format. Check out the link in the description.
To wrap up this deep dive, here's a thought for you to consider, based on what we've seen with Remark. In the face of incredibly rapid AI innovation, how much resource is truly needed for smaller players to compete effectively against giants investing billions? And can they ever genuinely bridge that immense resource gap?
Or perhaps this. In a world understandably captivated by shiny, futuristic technology, how often do investors overlook the basic, fundamental financial health and competent management that ultimately determine whether a company can even survive long enough to see its innovations mature? Something to think about.
Keep those questions in mind as you look at companies in exciting sectors. The fundamentals always matter.
If you found this deep dive valuable, we strongly encourage you to subscribe to the Stock Analytics AI YouTube channel. You can find the link in the description below. That's where you can find more deep dives like this.
And please remember, this deep dive is for informational purposes only and does not constitute investment advice. It's based solely on the provided public data and analysis as of May 23, 2025.
That's right.
Investing in microcap stocks like Remark Holdings carries an extremely high degree of risk, including the potential for complete loss of your capital.
Past performance is not indicative of future results. Always conduct your own thorough due diligence and consult with a qualified financial advisor before making any investment decisions.
This analysis was based on AI-driven research from the sources provided, but it is not and should not be interpreted as investment advice. Do your own homework.
Thanks for diving deep with us today.